Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, March the 26th, and I want to take just a brief minute to discuss what equity markets did last week as the markets continued their downward trend as the war in Iran continued on and oil prices remained elevated, with the S&P 500 being down 1.6% on the week. As of last week, the S&P 400, which represents the mid-cap index, was down a little worse, down 2.03%, and the small caps, as measured by the S&P 600, were the laggards on the week, and they were down 2.4% on the week. And as we have continued through the operation in Iran, what's happening in the market, and on a day-to-day basis, if you're just trading the market, what you can really just look at, it's become as simplistic as this, is as oil prices go up, stocks go down, oil prices come down, stocks go up, and we've had a lot of conflicting headlines throughout the week on are there talks, what the talks are going between the United States and Iran, which is causing a lot of fluctuation on the price of oil. And that's creating volatility in the equity markets. And there's questions about if and when and who the Strait of Hormuz is going to be open, who's going to be controlling that. And that has been what is impacting oil prices. But that has been what has been the recent spike in volatility in equity markets, is because of that. But there's been now so many worries that have entered into the market, and there's so many different things that we could talk about today that are going on within the equity markets. But I just wanted to touch on just a few that are going on. And so as we were going into this year, what's interesting that we're seeing is while the market itself is only down 5% or so, roughly 5% as we're speaking at 1:30 on Thursday the 26th, you have over 40% of the S&P 500 itself, individual equities, that are down 20% or more year to date. They're in bear market territory. And so what was interesting is even as we were going in before this conflict started in the Middle East, we were in this massive rotation. You were seeing software as a service companies in massive drawdowns as there were fears of AI replacing their technology and their technology becoming obsolete. And so those worries happen in the financial sector. You'll see the financial sector is one of the laggards year to date. It was one of the winners last year. But what's holding the financial sector back right now is the worries about private credit. And what's interesting about what's happening in private credit is you've seen a massive amount of influx over the last 2 years into these private credit funds, primarily on the retail side. And what retail investors are typically not as versed with and have more liquidity needs than these funds provide. So for example, if you were to invest $100,000 in one of these private credit funds that you've heard about on CNBC or Fox Business or the Wall Street Journal that are making the front page news, the way that these work is they give about a 5% redemption rate per quarter. And so that is, $5,000 a quarter if you had a $100,000 investment in that. And so what that does is it allows that entity to keep loans going and keep capital flowing on the business. And so what's happened is you've had such an influx of capital in these funds, and there's now some worries about, well, if you have these big SaaS companies that are losing valuation in the public markets, well, they've got to be losing valuation in the private markets. And who holds the debt? It's these private credit funds that are being held now by a lot of retail investors. And so you're seeing some selling and pressure in those, and that has a ripple effect through the whole financial sector because banks lend to these private credit facilities often to help them fund their redemptions. So that is what's causing that in the financial sector. And now with the price of oil increasing, there's now worry that, well, we may not get those Fed rate cuts that we were expecting this year, and now there's even some talk of potentially some hikes this year, and that's caused the 10-year Treasury to run from under 4% around a month or so ago, and now it's trading as of today at 4.40, at 130, 4.40% as of 130 on the 26th. So massive run up in the 10-year treasury that has an impact on mortgages, housing, and in the economy. And what that's telling you is that investors are believing that inflation is going to be elevated, and that the oil prices are going to have an inflationary effect on the United States. So these are all of the things that the market is conceding or dealing with at the moment, and still we're only 5% off all-time highs, and that is a lot to do with the amount of liquidity that is still going to be pumped into the system and the stimulatory activities that are still happening globally. So expect some near-term volatility. If you expect the rotation to continue from growth to value, if we're able to end this conflict on a shorter term horizon. But if you have questions about how to navigate through this and how we can help in any way, we'd love the opportunity to speak to you. You can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Thanks so much for watching.